All right. Well, welcome to this afternoon's session on blockchain technology. We've got an amazing panel here to discuss certainly one of the most talked about technologies and innovations in recent years. One of the most controversial, one of the most difficult to understand. So hopefully for those of you who are new to this technology, we can send you away with a little clearer insight into what this actually offers, what new you can do with blockchain that you couldn't do before. Some perspectives on the markets, what's happening with price, and maybe even a few predictions. So we'll just do brief introductions here to kick things off. So first, my name is Garrick Hileman. I'm the head of research at blockchain.com, which is one of the largest crypto asset platforms in the space, over 30 million wallets to date. And I've also been working in academia over a number of years, publishing research and teaching at the University of Cambridge, LSE, and elsewhere. Jamie, do you want to?
Jamie Burke, CEO and founder of Outlier Ventures. We were set up over 4.5 years ago. We were Europe's first dedicated blockchain investment vehicle. Since then, we've extended our thesis beyond just blockchain, but how blockchain converges with IoT, AI, big data. And we were lead investor on projects like Iota and several others.
I'm Sally Eaves. I'm a professor of advanced technology, specializing in blockchain and AI. And I'm also CEO of SAX, which is Sustainable Asset Exchange. And it's particularly looking at fair, ethical supply, basically using blockchain for proof of provenance, particularly in developing nations. I'm also founder of Aspirational Futures that's helping to build talent and inclusion and diversity in the sector, basically.
Hi, I'm Kiernan, the CEO of Dag Global. We're a startup bank that operates in the digital asset space in the UK. We've applied to the sandbox of the FCA, which is the playground for trying out new regulation. My own background, I was at the first bank in the world in Switzerland to be regulated to handle digital assets on a obviously regulated basis. So we worked as a bridge between fiat and crypto.
Hello, everyone. I'm Ioana Surpateanu. I am co-head of government affairs for Citi. I think everyone in the room knows Citi. If you don't, it's one of the biggest global financial institutions. My connection to the crypto ecosystem is mainly via regulatory and policy-making angle because I follow EU-level policy-making and regulation in the space, but I also engage with our innovation teams across businesses trying to look at how we can best capture these new technologies, blockchain being one of them.
Okay, great. So we're going to try to keep this session highly interactive, by the way. We want you asking questions. We've got a microphone. And to start off with, actually, I'm going to ask you a question, just so we can get a sense of our audience here. How many people either have owned or currently own any crypto asset, Bitcoin or something other than Bitcoin? Okay.
Commiserations.
So that's, and you know, maybe a few more that don't want to raise their hands, particularly if you still own crypto assets that have held on through this 80% sell-off this year. So, you know, a decent number of people in the audience. I'm just curious, how many people own something other than Bitcoin and Ethereum? So most of the same hands own something beyond the top two or top three. Okay, that's quite interesting. Okay, great. Well, we've got
One more question?
Sure, go ahead.
How many, is that personal or institutional? So maybe personal and institutional? Okay.
Yep. Okay, and then how many of you out there actually receive your salary in cryptocurrency?
Oh.
Okay. Am I the only person who does? Okay.
Indirectly.
So one thing you'll immediately know is we've got quite a group of passionate people about this technology on stage. So it's a little unbalanced in that regard. I'm going to be wearing kind of the devil's advocate hat a little bit, the foil, if you will, to try to like poke some holes in some of the positivity that maybe this panel is slightly skewed to talk about. But we also would love for you as well to engage and ask hard questions of us. So first I think we should start off with maybe some commentary on price, because that's kind of been a big story in recent weeks and for this year as well. We've seen the markets sell off quite dramatically. Jamie, what's your reaction to this year's sell-off? Was this something that was wholly anticipated based on what happened last year? Do you think markets could go further down? Where is the bottom? How big of a problem is this kind of volatility and this sell-off for the adoption of crypto and blockchain technology?
Well, if you've been in crypto long enough, you know to never call the bottom. So I wouldn't want to do that. But I would say Certainly for us, as I said, we've been investing in the space for over 4.5 years, through a few cycles. And I wrote a blog post probably 10th of January called Let's Get Back to the Future, which basically said that everyone got very distracted with this kind of speculative momentum trading that wasn't really tied to any underlying value. So I was kind of asking everybody to get back to the job of building the future. So I think at the time I called it about 50% haircut, then I corrected it to about 75%. Obviously it's been much deeper than that and arguably a bit more sustained. So I think it was inevitable in that people that are close to the technology, it was very clear that the amount of capital that was being thrown around was uncorrelated to underlying value. There was so much more infrastructure that needed to be built. And what was most concerning actually was the amount of money that was going into projects at the application layer when the infrastructure just wasn't there to support those use cases, at least in the short term. So I think to any sane person close to the technology, it felt unsustainable. And of course, bubbles are inherent to new technologies when capital can't kind of quantify an innovation. So everybody knows all the innovations that are going to be possible through distributed ledger technology, smart contracts, and the idea of digital assets that are native to the internet native money, or digitally scarce assets. And so I think everybody can see that potential, but the reality is there's so much more infrastructure that needs to be built. So that's where we focused our investments. And as a consequence, we've taken 10-year horizons on what we're investing. We make sure that the projects that we're involved in have raised money, and most raise money privately, by the way, not through ICOs. They have enough runway for 2, 3, 4, 5 years. So they've got more than enough capital to see out any movements in the market. I think there's a number of different theories about what's caused the crash, like the actual moment that it happened and why. The previous one was that people who were selling off, ICOs were selling off their ETH treasuries. That actually got dismissed yesterday. There's an interesting report that came out which said it was only a fractional amount of ETH supply that was effectively sold. And actually the biggest problem with most of these projects is they didn't sell enough of their ETH treasury. And so they've gone bust, they've lost their runway.
But just your view is that there is enough money held by these ICO projects to actually deliver on their commitments, to actually build out their networks, that this big 80%, 90% correction is you think there are going to be some projects that are going to...
Yeah. Most are already dead. Most funds, crypto funds, by the way, are already dead. I mean, it's brutal.
So a lot of the infrastructure that was promised as part of ICOs is never going to get built. The funds just aren't there because they held on to their ETH.
Those that basically sold, so if you're designing for a digital economy, and you then sell 50% of circulating supply, and you maybe retain a portion of that, and some sold more, and then you hold the treasury in ETH or Bitcoin, and maybe that's forced through vesting, and sometimes it's been optional, then you've just lost millions and millions. And so most are dead and buried. I'm happy to say that almost all of our projects are very well capitalized. They've liquidated their positions very early on. Their costs are in fiat, therefore their treasury is in fiat, maybe with a bit of exposure. So good projects with good treasury management are fine. And actually, I would say it's a big opportunity for them. So I don't know if everybody's aware of the Fad Protocol Thesis, but the idea is what's different about Web 3 compared to Web 2 is that value will accrue at the protocol layer rather than the application layer. So rather than within a Facebook or a Google, it will happen within a HTTP or an SMTP. Now, what's interesting about that thesis is if you're a well-capitalized protocol in a bear market, you can become very acquisitive. So you can start to acquire market traction and network market fit. And what's interesting about that is a protocol, an open source tokenized protocol can acquire an equity company. An equity company can't acquire a tokenized protocol. And so actually, I think you're going to see a lot of very aggressive moves. And I think M&A is up this year more than any other year combined in aggregate.
Okay, great.
So,
So on the subject of price, because I want to give the rest of the panel a chance, Sean, do you want to come in and say anything about price, or anyone else before we move on to kind of other topics?
Yeah, at first I'd distinguish probably 3 different types of digital assets. I think cryptocurrencies is one, utility tokens is the second, and there we've seen the big drop in value. And the third is what I think is the most interesting, but what we were talking about before, which is more the asset-backed values which are represented digitally. I think in the cryptocurrency space, Bitcoin seems to have emerged as the leader, obviously, and yes, it's gone down quite a bit, probably still go down a bit more. But long term, I think there is a place for a digital gold standard, and it seems to have emerged as the first one, the biggest one. In terms of the ICO space, I think I would very much take caution. If you look at what it actually is, it's basically a voucher or a coupon to access an instrument. And if you look at the traditional markets, there really is no secondary market for vouchers or coupons outside of maybe air miles. And I think in the third type, which is the most interesting one, it basically is traditional assets represented on a digital platform. And those can be fractionalized, made more efficient, additional liquidity. And I think eventually that's where I put my money.
Yeah, and why is asset-backed security, tokens? What's so interesting about that? Again, I'm why can't we do that basically already with ETFs and other traditional financial infrastructure and instruments? Where's the big value add with tokenizing a traditional asset like real estate or gold, what have you?
I mean, I think liquidity and fractionalizing are two main benefits. But I think the other one, which is really not explored yet, is cost. If we look at SME funding, for example, particularly in the West, there's been a lot of companies which have very interesting ideas which are not getting funded. And if you look in the past, before Tier 1 capital ratios increase in requirements for banks played a role to inject liquidity into the sector. Now there's a chance you can raise a digital bond, for example, where instead of a bond costing you 100,000, several hundred thousand, this can cost you 10,000. And if you can create a reduction to the barriers to entry to raise money for these types of SMEs that need debt and equity financing, you can create a new market, in effect, which is underserved today.
Okay, so liquidity, cost advantages, potentially fractionalization, those are the things you're pushing. Let's now talk about the technology, and Sally, this is a chance for you to come in here. What can you really do differently with blockchain technology, distributed ledger technology? What new things does it really afford that have you excited about its potential?
Well, one thing that I'm particularly passionate about is how we can do using technology for good, basically. That's what I really, really am passionate about. And we talk a lot, and there's a lot of events that talk about how blockchain can transform different industries within business, particularly within finance. But I kind of look beyond that. So looking, for example, in the world at the moment, we've got 1.7 billion people who are either underbanked or unbanked at all. We've got 5 times more people with phones than with bank accounts. So I'm looking at areas like that. I work very, very closely with the UN, for example. So we can do great business, but we can do so much more than that. We can tie what we're doing to things like the Sustainable Development Goals. And all the projects I've been working on are all about the notion of value, but shared value. So how we can do more. So for me, that's what I'm really, really keen to kind of promote here. We were talking there about different types of uses of blockchain. And so one thing that I'm doing is with physical assets being digitalized, but what are we talking about there? We're talking about trust, we're talking about traceability. At the moment, we've got, for example, oud trees, agarwood, that's very, very familiar in the MENA region, less so in Western areas, but it's used for perfume, but it's also used for well-being and cancer treatments and things like that. At the moment, it's a $10 to $20 billion industry. Half of that is illegal trade. So in order to get the product, get this substance called oud, the tree's being hacked. People don't know how to do that properly. Farmers are not getting rewarded. They're getting, like kind of a hundredth of what it's actually worth. All the way along the line, you've got environmental damage. You've got people not being rewarded and getting fair rewards. So it's all about ethical, fair supply chains. For me, that's a massive use for blockchain technology, and it's probably the most under-talked about, yet it's the most natural fit. So for me, when we're talking about value and we're talking about things we can do, let's look beyond the obvious. Let's look about how we can do great business, but also create more social change and really make a difference here. So that's kind of the theme that will come from me today, to be honest.
So for about 3 years now, this term blockchain has kind of been heavily hyped, magazine covers, people out there, like Mathers, telling us this is going to be as radical and transformative as the internet. 3 years on, though, what we haven't really seen a lot in terms of kind of, either governments really doing a lot significantly with blockchain technology, banks who are the earliest, I think, to kind of look at this and think about how this could be exploited. Ioana, why have there been such barriers to kind of, real-world use cases beyond, frankly, Bitcoin as maybe a store of value, Ethereum as a crowdfunding platform, and maybe crypto assets as a low-cost remittances cross-border payment system? Those are really the 3 things the public cryptos have been used for, really, that have maybe improved what we had before. Why haven't banks done more with this technology? What's going on?
I think banks are starting to get pretty strong in the space. There are a couple of issues. One of them is regulatory and clarity. And this is very important when it comes to actually defining these digital assets, crypto assets, if you will. Another angle to look at this from is the fact that we're still speaking about an emerging technology. I know it feels like we're all experts in this and we've been talking about it for so long, but it's still emerging technology, still frontier technology. We're still testing to see what the best use cases for it are. So far, I think financial institutions have focused a lot on deploying DLT in private permission settings for process optimization around clearing, settlement, payment messaging, post-trade finance, etc. And this is one of the benefits. And I think we're going to see a lot more projects in that sphere as we move on. Another important aspect when it comes to blockchain, for me personally at least, is the fact that this new code-enforced trust that blockchain enables will generate a mass of software-based internet-native business models. So if you now have the capacity via this trust primitive to have people with common goals, companies that have common goals but don't trust each other, to actually collaborate and build up networks, and even as Jamie was suggesting, digital economies, decentralized digital economies at one point, this is a very powerful tool. The fact that you can create, design large-scale open source systems where the interaction, the most optimal interaction actually generates value in terms of network effects and appreciation of tokens, because tokens are being deployed to incentivize this whole network movement. This is a very powerful tool. These are the new internet, the actual only internet native business models, because what we've seen so far is a application of the ad-based model into online platforms. And now we're starting to see the creation of these truly internet native business models that for banks will definitely be the clients of tomorrow. And the challenge resides on how we will find the right rails to interact with them, and also how we collaborate and make sure that this ecosystem evolves in the right way as it develops.
Great.
Because it's not known at the moment.
I want to come back to something you mentioned, because this gets talked about a lot. Regulatory clarity. This is something that's mentioned frequently as one of the big kind of questions that's hanging over the space, and that, you know, if we only had regulatory clarity, this institutional wall of money would come flooding in, and you know, DLT and smart contracts would be deployed by banks and so on. What does that mean? What does regulatory clarity mean? We've got states like Ohio now actually accepting, you know, tax payments in crypto. You've had the Securities and Exchange Commission issue a number of major enforcement actions, guidance on what is a security, what are the penalties if you don't register. You've got countries like Japan that have actually legalized, you know, the use of cryptocurrency. How much more regulatory clarity do we need? What does that look like? Where is this end state where we have enough? Anyone?
Yeah, well, I mean, I think from our perspective as an investor, there's a certain amount of risk you assume by participating in this asset class, and actually more so because we're an advisor as well. So, and you know, for us, actually, you know, you look at the FCA, even the SEC. Generally, their approach has been to observe. They didn't feel that they had enough data points, to be honest with you, to understand the market enough to understand the market behaviors. And of course, they've been enforcing low-hanging fruit. There have been some clear securities violations. People have been promoting with an expectation of profit and all kinds of very naughty things, and raising money indiscriminately. So I think that's all fine. I think what most investors and projects would like to see is some leadership from a tier one market. So it's great that we've got Singapore, and it's great we've got Zug, Malta, and what have you. But you know, the reality is that whether you're an exchange, whether you're a fund, or whether you're an issuer of a token, you'd much rather be in a primary market with an established capital markets infrastructure. And for that to happen, really we need to have a clear distinction between what would be determined to be a security and what could be classed as a utility token. And actually, it's not that far. I think most regulators actually conceptually get it. I've had a number of conversations. The problem is that they don't want to give permission. So they're kind of defining by action. And I think ultimately, the reason why, from my perspective, definition around utility token is important is that the most exciting thing about the innovation of distributed ledger technologies and digitally scarce assets is that to what Ioana was talking through is it's a coordination mechanism. So it's been slightly abused as a crowdfunding tool, but the reality is its true purpose, tokenization as a whole, means that you can begin to hard code game theory into open source systems. Now that sounds complex, and of course it really is, but the big innovation we saw, so investing in the space for 4.5 years, until the advent of the ICO, everything was proprietary. So people were they were taking open source technologies and then trying to create proprietary technology with it, and there was this disconnect. The minute that the ICO came along, people realized that there was a means through which they could open source the technology and still have a business model. They could still make money. So we'd seen 90% of projects that would approach us be open source day one. Now that is really transformative if you think about how inefficient traditional startup technology financing is. 90% of startups fail in their first 3 years. Billions are lost forever, all values lost. It's a really stop, start, zero-sum game. And usually it means they get acquired, that's success, and it coalesces within a few monopolies. The opportunity here is that a project can be open source day one, it can fail, its code base can be taken by somebody else in parallel sometimes and reapplied. And so we're going to see much greater leaps, technological leaps as a consequence of having this thing that is a genuine, serves a genuine utility in the coordination of a network. And that's separate to how it's sold. Yep. So I think you can have a utility token, it can maintain that status as long as you don't break security laws in how you sell it, market it, promote it.
Sure. So at this point, we're about halfway into this. I want to start giving the audience a chance to kind of come in and ask questions of specific panelists or throw questions at the panel as a whole. We don't have to take a question right this second, but we certainly could if there's someone who has a burning question. If you want to see us go in a slightly different direction. Yes, sir.
Yes, good afternoon. I'm Scott Young. I'm on the board of Cambridge Quantum, and I suppose something perhaps for Sean or Ioana. Extraordinary development, obviously, over the last 2 to 3 years in blockchain and cryptocurrencies. What kind of infrastructure is being put in place to be prepared for the coming quantum age, which I think many people is coming much faster than even many experts have predicted in terms of encryption, hackability, and so forth. Thank you.
Yeah, I actually can say something about this. We, at Blockchain, we actually fund research at Imperial College here, just down the road, and just saw a presentation from one of their students on how to introduce quantum-resistant, technology,
Ledgers.
Basically replacement for ECDSA into the Bitcoin blockchain. So there are parts of the Bitcoin, kind of cryptography that already are quantum resistant. Other parts are not, and that will need to be substituted over time if quantum computers do finally materialize. I still have my questions about how quickly that will actually happen, but there is thinking already going on around this point. Does anyone else want to comment on quantum?
Yes, just a couple of comments. In a private permission setting, you can upgrade the ledger to quantum resistance. So the whole issue of quantum breaking public key cryptography does not necessarily apply in that context, which is good. And it explains why institutional investors, institutional money haven't penetrated so much of the crypto ecosystem so far, because they're still looking at the safest solution at the moment. And just to echo, I actually have read that Imperial College quantum resistant paper, and it gives a solution. What happens is that with quantum computing, with quantum computers, they can break the moment you deduct your public key from your private key. Via quantum computers, you can actually know the private key as well, and that unlocks access to all of the Bitcoin or other cryptocurrency accounts or other tokens. So that's one of the main issues. And it is going to be an issue for a public blockchain, because even if you upgrade the ledger from the point in time where it was broken by quantum, what do you do with the transactions up to that point? So it is a really important issue, but I know a couple of research teams are working on it, and I'm happy and proud to say that the Citi cyber team has a dedicated team of 10 people looking at quantum computing, quantum computers, and how they will affect technology in the years to come.
Maybe just to connect it to the previous question as well. I think regulation obviously is one of the most important areas in this space to get right. That's why we're in the sandbox. And I agree that a major economy needs to really put its foot forward for people to get comfort, to put real money into it. But I think
has Japan not gone far enough, though? I mean, Japan certainly qualifies as a tier 1 economy. Are we really talking that we need the United States or the EU, basically? I mean, is it those two that really need to step forward?
I don't think Japan has gone... They've regulated in a very narrow capacity. So a utility token could be applied to any use in any open source system. And so it's almost undefinable. That's part of the challenge. So I don't think Japan have gone far enough.
Okay. Yep.
And we also don't see the Japanese banks yet really going into the space. Yes, on the back end, but I think it's that distinction between the front end and the back end of banking that I would make as the next big jump. And particularly on the settlement side, T+1, T+2 settlements and paper-based settlements for funds is actually crazy when you think of the world we're living in being digital. And I think there is a place for security clearance companies being centralized, and that's where I think the protection from quantum computing hacking would be, because there will be some agent in the sub-custody layer that I think will be looking after these things. But until we get to that level where people can actually transact on probably a private blockchain, intra-company or inter-company, this is still some time away and needs regulation first before big players go onto that rail.
Okay, great.
Can I chip in on the regulatory
Sure.
question? You asked how far should we go? We haven't gone far enough because there's no clear definition of these assets, of what these assets are, what economic function they perform. So for a bank like Citi to actually look at this from the perspective of a new asset class and start building financial products and instruments around it, we need to understand what they are, and we don't. So far, the regulatory methodology has been around decoupling the underlying tech, DLT tech, from the applications, looking at DLT, understanding that DLT does not in itself need to be regulated. Maybe there's need for some legal clarity around certain aspects, mostly around smart contracts. And I think the regulators are now going to be looking more granularly at these crypto/digital assets. So far, we have a breakdown, generic breakdown, I would say, of payment, utility, and security tokens based on the functionality of the token, but it's not enough. We need to have a much more in-depth understanding of how these tokens function on the primary and on the secondary market to understand what fits into financial laws and what doesn't. And I think utility tokens will be out of that realm altogether because they don't represent anything that could be now integrated into financial laws. And to summarize, the approach so far has been to look at the space, at these tokens and the functions that they perform from a already familiar with financial instruments that operate in a different setting. And I think that perception and the approach is going to change Q1 2019.
Mm-hmm. Great.
I quickly come in on the quantum
please, yeah, I was
one
gonna
as
turn
well.
back to you, yeah.
With your question about that, there's one thing that I know that I'm involved in, which is looking at some of the challenges of blockchain at the moment, around energy, for example. There's a specific use of quantum that's particularly exciting. So I'm working with a big tech company in a certain university, and if anybody's interested in that, I can't share it here for certain reasons, but if you're interested, we can take that offline, because it resolves going a long way to resolve one of the biggest challenges we have. So I'm happy to take that offline with you and chat in a bit more detail. Okay.
Got a question here in the front here.
What Professor Sully said, I'm an impact investor, and particularly looking at the use case of medical records.
Okay, fantastic.
And found that it was absolutely perfect for
Absolutely.
an ICO.
Yep.
And about a year ago started on a journey to do that.
Okay.
I just wonder whether the hidden thing, I think you've referred to it, is we went down a track where initially it was going to be a coin offering.
Yep.
The market started to wobble, and we were advised to go to an STO.
Yes.
And then I've previously been the chairman of a PLC on the London Stock Exchange,
okay.
and encouraged my team to follow the same kind of regulation that would have had.
Yep.
And then before you know where you are, you've reinvented floating your business and calling it an STO.
Yep.
And I just wonder whether fundamentally behind it is what we seem to be working around was the fact that we were having to write a contract where the concept of a trustless system, which as a techie I love,
Yep.
is not actually deliverable with the technology today, and you have to almost write it as if you're going to do it, not knowing how you're going to.
I would concur with that. And I'd also, just in terms of use cases, that was one of the questions earlier on, apart from supply chain and finance, health tech, again, it's a massive, massive opportunity. And DNA is another example of that as well. So I'd love to talk to you about that offline because I'm quite involved in around precision medicine. And again, the marriage of blockchain, AI, machine learning, these areas around integration, again, that's where I see the biggest catalyst for innovation. So I'm very involved in that area. So I'd love to discuss that with you in more detail. I totally agree with what you were saying. But in terms of the applications and what could be done, that's something I've done quite a deep dive in over the last year and a half. So yeah, we can definitely look at that. So I agree with you, yeah, wholeheartedly.
I would also add that, as I said earlier, there were a lot of projects where they saw a clear purpose and use of distributed ledger technology within a particular vertical or what have you. And there's kind of this eagerness to raise capital, to build their own protocol with their own token, to deploy against it. And honestly, most use cases don't need their own token. There's some critical infrastructure that needs to be built around connecting up to IoT devices, data marketplaces, native identity to the web, native trust to the web. So until you've got any of those things, any solution you build will be heavily centralized. And that's okay, by the way. I think decentralization should be a pathway, and actually it's multidimensional. So there's probably no token in market that you could say is truly, totally decentralized. But what's starting to happen as a consequence of the bear market now, the only people left standing with money are traditional venture, a lot of institutional money. And all they're interested in investing in at the moment are real businesses with real revenue. Now, the fact that you happen to deliver that through distributed ledger technology, whether that's your own or somebody else's, is kind of interesting to them, but not the point. And so what will start to happen is you'll start to have increasingly, so previously there's been a lot of focus at the protocol layer, and we still do focus there. But it's only going to be application layer that's going to be getting, or market layer that's going to be getting investment at the moment. And the consequence is they will have to build down into the stack to execute the infrastructure. And then very likely they'll open source that infrastructure for other people to use in a more general purpose. And very likely they'll tokenize it. And so one of the interesting things that's happening is a lot of venture firms and corporate venture firms are accidentally ending up with crypto assets on their balance sheet. And I was like, what the hell is this? We really don't need this headache. They've invested in a company, a real business, and all of a sudden, for them to execute, they've had to build down stack. So I think you're just seeing this cyclical shift from infrastructure to application layer. When the market picks up, it will go back down to infrastructure. The main thing, and I don't really care where it happens, the main thing is that at some point these two things converge. You have, we call it network market fit, where the protocol actually hits the rubber of a market and has real use cases. And so there's many different pathways to get there, but I think what we saw with the ICO boom was people were raising capital to then go and try and build this infrastructure, and it's very complex infrastructure, and some really complicated problems yet to be solved. So I'd much rather people just have a business and execute, and it be fairly centralized to start with, but they have this pathway, either they build it or they wait for somebody to build it before they start to decentralize and automate.
So there was a question, yes, from here, and then I saw another one here in the center. This gentleman here with the, thank you.
So from the investor perspective, we're always very cautious about regulatory risk. And blockchain is much more than crypto. So I'm kind of curious to hear from the panel as to what sectors do you see the biggest opportunity to invest in blockchain that doesn't have the regulatory risk that currently exists?
I think the Securities and Exchange Commission coming out and saying that Bitcoin and Ethereum are not securities and that sufficiently decentralized blockchains, that was a huge, I think, step in the right direction for regulatory clarity, and partly why I pose that question: how much more regulatory clarity do you need with something like Bitcoin? You've got the U.S. Marshals selling it, you've got states accepting it for taxes. I mean, it's starting to look like pretty good regulatory clarity, at least around something like Bitcoin. You've got futures markets and so on, right?
Then give something a no action. They still refuse to give things no action. So they invite people to come to speak to them. They waste their time, largely, and then they don't give them a no action. So I agree with you that the thing is, I think they've already made a lot of their decisions, right? But they're still holding back on why not create a sandbox environment? Why not give permissions? I know the French government, the finance minister, actively said that he created an opt-in environment where you could choose to come in to have the rubber stamp subject to passing a few criteria. It's not a big ask, right?
And there are important things that are being held back. The SEC has made it clear they're not going to approve a Bitcoin ETF anytime soon. There's concerns around market manipulation. They're not going to have a regulated financial instrument where there's unclear price action, wash trading, fake volume, et cetera. So there are certainly some big issues that are hanging over even the biggest assets in this space like Bitcoin. But I do think we have come quite a long ways in the last 12 months. You've got commissioners at the Commodities Futures and Trading Commission saying, these assets are not going away, and Rusty was even saying that we're witnessing a modern miracle. I mean, the kind of talk that you typically hear coming from Silicon Valley and people like Tim Draper, right? Coming from CFTC commissioners. So a lot of progress has been made, but yeah, still some key barriers to overcome.
Could I just try to answer the question directly, which is, so I like to slightly turn it on its head in that one of the most interesting use cases of distributed ledger technology and crypto assets, actually, is around enablement of data marketplaces and AI. And so the question of which use cases have the most applicability to distributed ledger technology, I actually say are big AI problems. So you think about the existential threat of the way that the web's constructed at the moment is platform monopolies have led to data monopolies, have led to AI monopolies. So there are a handful of organizations where governments are literally handing over citizens' data. DeepMind, NHS, how many smart cities, the Smart City Lab Walk program in Toronto, because they have no other alternative to derive value from our data. And so I think there is a real opportunity to create a decentralized alternative to data marketplaces, specifically for the purpose of AI. And so if you think about the use cases of those, it's health, you could apply it to insurance, any number of different verticals.
Great. Right here.
Yeah,
and then
Ioana,
you want
I wanted to add something to his question. I'm going to go back to what I was saying earlier around open source and decentralized collaboration that would enable the creation of large-scale decentralized systems. In order for that collaboration to happen in a decentralized fashion, you need to have three things. Mechanism of enforcement, incentive mechanism, and digital identity. Not digital identity, but a decentralized reputation system that is going to be built around the best solution on digital identity. So if I were to make my bet, without giving any investment advice, of course, it would be target those solutions that are going to be building a scaled-up decentralized identity, decentralized digital identity solution. Because this is what's missing currently in the space. You don't have a strong social signal, decentralized social signal. You cannot correlate, for instance, Bitcoin addresses with the actual person who enables all these transactions, et cetera. So that reputation, decentralized reputation system is missing. And it's a big enabler of collaboration. And I think this is where we are going to see a lot of solution in the space. And actually, one of Jamie's portfolio investment companies is working on that. And I'll leave it to you to...
I just want to build on it one more time. So sorry, I know I'm hogging a little bit. But so if you think about the internet population as it exists today, right? So roughly half of it are people, and the other half are bots, and half of those bots are naughty bots. They're bad bots that we don't want on the web, right? And the reason why they exist is because there is no cost to their behavior. So that's why when you have disincentives and incentives built into a new web architecture, it means that we can potentially have a web that functions more appropriately. Similarly, there are more devices connected to the internet than people now. And a huge part of those are mobile devices. So when we're thinking about new web architecture, we're not really thinking about, the use cases are always people. Actually, the biggest use cases are going to be machine-to-machine economy, agent to agent, bot to bot. And they're going to be transacting through a native internet currency, unit of value. The great thing is they're, in theory, logical. So actually, if you set some rules into motion, they will follow those rules. And so that's the most interesting way to think about what we can do with this new web architecture, is how can we program new automated and machine-to-machine web, not just serve individual e-commerce transactions or what have you.
Yep, please, right here in the center. Yep. I think he was, yep.
Tokenized securities. I think one of the great failures of our capital markets has been, and my interest is the Sustainable Development Goals, is transparency, is governance, is also access to capital. We've had capital concentration towards essentially speculation and big business, and we have, starved what I call the plankton of our economic food chain, the job creators and the innovators. So the question is, where do you see blockchain, and particularly what I think is the next wave, tokenized securities and smart contracts within them that can actually address the governance issue, the transparency issue, and really get us to democratize capital intelligently to address the issues that we have to address urgently and we're really not doing. So, simple question.
Sally or Sean, you want to, I'm sure you both want to come in on this, yeah.
Maybe just, I'll start. I think crowdfunding is probably a good example of some regulation, some businesses that have grown up looking to address that same issue. And if we look at what's happened, it's primarily a retail investor play that looks to go in at a smaller segment. And typically the sizes that you can go in at crowdfunding are typically below 3 million plus minus. What you're trying to address is something that I think is a big issue, that there's a gap now, I would say 5 million to 100 million projects, which are really not addressed by the traditional financial systems. And this is more of an institutional play on some levels, and the question is, how do you get institutional instruments in a way that they can be understood and clear to institutional investors? I think the two issues here are governance completely and identity, which we talked on. Governance is one thing that I think the whole blockchain sector is lacking overall. There's a lot of individual players that are trying to push particular languages of blockchains that have vested interest within them to succeed. But there's no body as yet which has come up with a formal standard to say, like an ICANN for the internet, this is how a governance structure can work for a blockchain to exchange value on top of it that can respect the different parties that work with it. And until I think we have that ecosystem emerging with regulation actors and a standards body that protects retail consumers but also gives institutional investors access, I think this is still a few years away. And we see the first signs of this potentially with some of the major stock exchanges like SIX Digital in Switzerland, now offering a platform for security tokens. And they're working with some of the big names that, I don't know if you can disclose in a forum like this, but that probably in 2020 will go live. I'd love to see that happen with the London Stock Exchange. I think there's quite a few places around the world that could do this, but it's going to take, I think, quite some time before we can address that market gap.
Yeah. Sally, do you want to?
I agree. And one thing I would probably add to that as well, that I also think is a challenge, is measurement, particularly when we're looking at things like sustainability and the SDGs, measures of social impact. And there's something coming out of the UN that I can share so much about, but can only go so far, but around social impact funding. And I've got a model that I've built with my research hat on for a minute about how we measure social impact outcomes. And there's also something as part of the project I'm directly involved in, which is around kind of saving and investing. And how people can kind of go from an investment of $1 and see an investment. All right, okay, I'm going to have to take this offline because I can only go so far. I really want to answer that question in more detail, and I'm going to get myself into trouble. So I'll take that offline with you. But there is some things, but honestly, this measurement point of view is absolutely critical when it comes to that. And in terms of the rise of social impact funding that I'm very much involved in, it's absolutely critical to success.
I think, by the way, I think a big one is a cooperative and the cooperative movement, platform co-ops. It seems almost like the perfect model for a decentralized web. And so I think when you see the marrying of the cooperative movement, which is, and DLT, which is starting to happen, something called the platform cooperative movement. From my perspective, the problem that it still has is it's coming from the cooperative angle and this discomfort with capitalism and as a whole. But I think that this fusion is starting to happen. I think you'll start to see that impact in places like Africa. So previously you had over-the-top banking with mobile. The really interesting thing about this space is that we've now got, so Bitcoin was the first native internet money. Because that was open sourced, anybody can create their own Bitcoin. That's created a native open economic layer for the web. So in theory, anybody can give birth to a digital economy anywhere in the world without a bank account. And anyone can participate in that in theory. You can plug in a node, start mining away. If you've got energy network connectivity, you can start to earn that native token and then obviously spend it within the limitations of that environment. So I think we haven't even come close to seeing that the explosion of socioeconomics. It's one of the largest experiments in socioeconomics we've ever witnessed. If you're an economist, I don't know how you can not be excited by this, by the way. It's just impossible.
Exactly.
Just one quick thing on that before we come. So this comment about this, the unbanked and some research has shown that, we know that it's more developed countries that have really gravitated to adopt crypto assets. First, it's not been sub-Saharan Africa. It's been South Korea, Japan, Europe, the United States, more economically well-off countries, people who have bank accounts already because crypto assets actually cost money to acquire, right? Or you need to mine them. Or we're starting to see more creative ways to get crypto assets into the hands of people who don't have a bank account, don't have resources to purchase them through things like airdrops. And apologize for the commercial here, but blockchain.com recently announced a $125 million airdrop of Stellar, which is a top 4 crypto asset. Why are we doing this? Why is Stellar doing this? Because a lot of people cannot afford to buy crypto assets around the world or can't connect their bank account to an exchange. And so actually, basically freely distributing these to a wallet, to a private key holder is one of the easiest ways to onboard millions of people into this ecosystem. And I think you're going to probably see a lot more high-quality airdrops conducted in the months and years ahead. Yes, sir. Thank you for waiting.
Well, this is a question for blockchain, really, which has got a terrible reputation. Most of people who are getting hacked have to pay the ransom in crypto assets, and it's in Bitcoin usually, because it basically is allowing shady people to hide. And so, on the other hand, people say, well, the FBI can trace whoever holds it, so that's not true. But I think it seems that you're still living in the world of sort of shady, sort of like, let's hide, and it's kind of infancy. And well, but then the reality is not communicated properly. Most of the demand, most of the real usage of crypto, and most of the regulator who's not moving is because it looks like it's shady.
Yeah,
so when are you going to do something?
So the data on this is actually shifted quite a bit. So early on, it was easy to show that online dark web marketplaces were the dominant, or online gambling, illegal gambling. These were the dominant, forms that cryptocurrencies like Bitcoin were used. And now the share, the value share of transactions flowing through those based on chain analytics data is gone way down compared to
3%.
Say, most of the use is actually investment. And to your point, I don't want to dismiss your point because I think there's a valid point there, and you might start to see some bifurcation of how certain crypto assets that are maybe a little easier to trace, like Bitcoin, are treated by regulators versus ones that have enhanced privacy. There's been some discussion at Homeland Security of greater interest in some of the more privacy-enhanced coins as being a concern compared to, say, Bitcoin, which regulators and law enforcement have gotten more comfortable tracking. But it's a real concern. Yeah, when the NHS gets its computers frozen by ransomware and the hacker demands Bitcoin. That's not good from a PR perspective. It's not good from a lot of different perspectives. We need to go after those people. And luckily with Bitcoin, it leaves a digital paper trail, and law enforcement has had some success recovering those funds and prosecuting people who've done bad with Bitcoin.
I mean, just linked to that, I'd be more concerned with the Equifax hack, right? So there are more substantial hacks happening day in, day out as a consequence of centralized systems, single point of failure, single point of attack. So this is why we invest in something called Sovereign, which allows for self-sovereign identity, which enables control of your personal data, which removes the risk and the cost, by the way, from the organization. So Equifax doesn't want to have to secure your data because it can't. It's a total pain in the ass. So by having this kind of native identity layer, and this is what I was saying earlier, there are some fundamental building blocks that need to be built before we're going to see the true value of a decentralized web. But equally, if you look at unsecured IoT devices, so we invested in Iota, which enables secure machine-to-machine value transfer that's affordable. Because if you look at the security risk of IoT devices, like toasters and fridges, there's a DDoS attack a few years ago that brought down the whole west coast of America internet for like an evening. And it was done through a DDoS attack of toasters and IoT devices. So, we have infrastructure that is systemic risk to the internet, to all the value that's transferred on it. And so, because a few hackers will ask for, by the way, stupidly, Bitcoin to be paid in, because it's pseudonymous, it's not anonymous. Yeah. And I also think, as you said, there's going to be a spectrum of privacy now. So there are tokens coming out that use zero-knowledge proofs, which basically say it allows you to reveal certain data about a transaction and where things came from. But it becomes optional. So I think the media likes to demonize new innovations. It's easy to do, but the reality is actually far from the truth.
Go ahead.
Go ahead.
I was just going to say this is something we've looked quite a bit at trying to build a bank and talk about flows of funds. How can you be sure the flows that you take in are clean? And you touched on this. There is quite a big sector now emerging called blockchain analysis or coin forensics, where you can trace the whole life cycle of a respective wallet or a coin, which I would say you cannot do in traditional fiat banking.
Cash.
You only know the last leg, and with cash, you have no idea where it comes from. Not that many banks take cash in large sums anymore, but they do take big wire transfers. If you take an inflow of Bitcoin, there is a trace, and there's a lot of work done, ex-CIA, GCHQ guys that have now gone into this space. And if you can see that there's a green, amber, or red light connected to that wallet, if there's an identity known, which there are now increasing identities known connected to wallets, you can say, basically, is this something that we have a risk appetite to take? And we'll see where it goes.
But again, you've got to look at it in, Deutsche Bank, right? I think the amount of money that was involved in that fraud was larger than the entire crypto market for a few years.
Danske Bank.
HSBC and, the existing financial system is very good at laundering money.
Yep.
To the tune of the entire crypto market.
No, just to, because there are a couple of, I'm an incumbent, I know, but there are a couple of fallacies that you referenced that I feel the need to shed some light on. Blockchain has not been hacked, not the big blockchains. It's the crypto exchanges that have, which is a centralized version allowing transactions to happen, right? So blockchain in itself has not. And yes, there are a couple of privacy coins. Bitcoin, as Jamie mentioned, is pseudonymous. There is Zcash and Monero. These are privacy coins that might be actually used sometime in the future when there's more stability in this space for big companies to share transactions, right? That could be a use case rather than hiding your identity for illicit purposes. And Monero is actually starting to be deconstructed, as far as I know. So there have been some glitches in their privacy. And by the way, another bank, not mine, has been using the zero-knowledge proof that Zcash has put forward to develop a very solid blockchain platform. So I think it's a fallacy to say that we're looking at this space from a shady operational perspective.
the view that they get from the people is that blockchain and other crypto is a place to hide.
I don't know.
I don't think that's
disagree.
correct.
I mean,
Yeah,
I
me
would
too.
say, I would give regulators more credit than that.
Yes.
You know, so if you look at what they've been doing, most of their action at the moment has been around exchanges, because exchanges are the best place for data points, right? And so, as you said, the reason on the ETF is because there is market manipulation. You've got to remember that this is something that's emerged bottom up from the internet, primarily as an academic experiment and exercise. So, you know, this is what we're watching as the professionalization of the industry, and I think that this panel is a representation of that, and the fact that all these people are in the room, which I assume represent the people, would probably speak to as well.
Yes, and I want to comment.
Sorry, we have to unfortunately pause, so we can continue the conversation in the hallway.
No, I have to say my comment.
You've got to say that. This is it.
I've got
Ioana
to
gets
say,
the last word. I'm not gonna
regulators
argue
are
with her.
not looking at it. So I'm going to be speaking strictly about the European Union and Europe more widely. Regulators are trying to enable adoption of this technology. They're trying to enable businesses that resort to this internet-based alternative access to capital instruments to flourish. This is why they are looking to regulate, to create more clarity in the space, to allow institutional people and companies, as well as retail investors, to join the space. And I don't ever miss the point.
Okay. All right. Thank you very much. Please join me in thanking our panel. Thank you.
Thank you.
Okay.